Guys, JC Parets here of StockCharts.com, and welcome to the show. Shout out StockCharts TV for having me on. David Keller, what's up? So we've been doing this now for, I don't know, like 6 months or so. It's been fun. We do it every week. We do 3 things here is what we try to do. The first thing, always get a lesson, right? Because let's say the charts that I bring are terrible. Let's say I get nothing right. At the very least, there's a good lesson to learn. That's the first thing we want to do. And the second thing, most importantly, in my opinion, let's dive into the charts. What are we looking at? What's got our attention? And then finally, let's answer some questions. I apologize. Last week, we didn't get to those questions, even though we sort of sprinkled in some of those answers in the charts, which we do every week. But sometimes at the end, we like to dive into some specific questions, and we'll try to do that this time. I'm going to do my best to keep it under, because then I got an email telling me I got above 29 minutes, and we don't want to get those emails. Shout out Gretchen. All right. So the lesson of the day, I think, is to be aware of market cycles and little mini bubbles that are always popping all the time. You see it constantly, right? It doesn't necessarily have to be a stock market bubble, but there's little bubbles. You know, you saw it in the SPACs. You saw it in growth stocks in general. You see it in the cryptocurrencies all the time. Usually with each of these bubbles, there's a poster child of some kind. In many cases, these are charlatans from prior cycles that have now moved on to, you know, whatever it is today. Maybe a former perma bull or from a perma bear is now a crypto expert. Or a former gold bug is now, you know, a crypto expert, or, you know, these SPAC people that were launching a zillion SPACs, then they just disappear all of a sudden after everybody lost their money. Just to be clear, this has been going on forever. So I think part of the evidence that we are weighing when it comes down to, hey, should we also dive into all these crazy SPACs, or should we let everybody lose their money when the rug gets pulled? You know, when you're trying to make these decisions, you want to think about it. It's like, okay, is there a poster child? Is there like a leader, so to speak, of this particular, you know, cycle, right? You know, you got the laser eyes with the cryptos. I put on shout out laser eyes. We are not long Bitcoin, by the way. I guess I got a little bit put away somewhere that I've had for a long time, but it's not like a position that I'd be trading. And I don't have like these long-term views about Bitcoin. I just have some Bitcoin that I've always had. Maybe I'll sell it one day, maybe I won't. It's nothing material. It can go to 0, I don't care. It can go to 1 million, I probably won't even make that much money. So needless to say, I don't have any exposure right now in Bitcoin. I got a little bit of Ethereum, but I almost have nothing. You know, reach out to us if you are interested in our new daily crypto letter, info@allstarcharts.com, and we'll send you some details on that if you haven't already. But the lesson of the day, forget all the crypto stuff. The lesson of the day is be aware of your surroundings. Be aware of what's happening in these cycles. If you think something's in an uptrend, and maybe you have convinced yourself that you are now some sort of expert in that field, and you have some information or some insight that others simply do not, I would say, whether that's true or not, maybe it is true, but I would say take the other side of that. Play devil's advocate against yourself and look around and find those cult leaders, if there are some in that area. And if you find them, chances are, then find out a little more about those cult leaders and see what they were doing in prior cycles, and see if they're just recycled losers. And in many cases, you'll find that they are. So just keep that in mind. And the lesson is be aware of your surroundings and try to figure out if this cycle is for real, is just getting started, or you're near the tail end and the rug's about to get pulled. SPACs are a recent great example of that. Growth stocks, you talk about Cathie Wood, sort of the poster child of that. These things have gotten destroyed. I think they continue to. We are actually shorting Cathie Wood's funds aggressively. I think that's a good trade. So just keep that in mind. Okay, great. So that's the lesson. Now let's dive into the charts. So we just got our monthly charts a couple days ago. As a matter of fact, on Monday was the last day of the month, and the market was closed here in the United States. So we actually got these last Friday. And what do we see? We see small cap growth stocks making new 16-month lows relative to value. Look at large cap growth relative to large cap value, new 12-month lows. So what do we know? We know that the trend in growth getting crushed has not ended, right? And then not only that, this is not a new trend either. This has been taking place for some time now, where growth stocks continue to underperform. This is not last year or 2017 or some of these other environments. This is an environment that investors have been rewarded for selling growth stocks and have not been rewarded for buying them. Investors around the world have been rewarded for buying value stocks. You can look at countries like Europe or Canada that have much more exposure to value and, more importantly, a lack of exposure to growth. Look at Canada. It's a ton of banks and natural resources, and industrials for that matter. Look at Europe, 3 times the exposure to industrials of the United States and a fraction of the tech exposure, most importantly. You could really see the outperformance out of these areas. Again, financials, energy, basic materials, industrials. Those are the areas that have been working. The growth areas like technology, for example, have not been working, and that hasn't changed. Now, could today be the low and now all of a sudden growth stocks are going to rip? Sure, that can happen, but that is absolutely not the bet that we are making. In fact, the bet we are making is that things get a lot worse for investors that have convinced themselves that they are quote unquote growth investors, whatever that means. In my opinion, if you are a growth investor, what you're really telling me is that you are unable to overcome your recency bias. That, to me, is the majority of quote unquote growth investors, because that's not really a thing. There are environments where growth stocks do well. Like, that's like calling yourself, and I'll get into this for a minute. I'll get into it. It's like calling yourself like a gold investor. I only invest in gold stocks. It's like, what even is that? What if gold's going down for a decade like it did? Or I only invest in growth stocks, or I only invest in US stocks. Like, why? That doesn't make any sense. Oh, because you've had success in the US. Oh, okay, great. Sure, because again, recency bias, right? There have been other environments where the US is an underperformer. So what are you then? You're an international stock investor? Listen, there's a time and a place for everything. And the time currently is not to be aggressively buying US stocks or growth stocks. It's really looking at value and potentially looking for more shorting opportunities in the growth areas. And that's really the big theme here. All right, how about this? Something we haven't seen in a long time. Look at Ford breaking out to new highs relative to Tesla. You look at the auto index fund, CARZ, and look at the components. The cars is just, the index has been ripping, and Tesla is just not participating. So it's really interesting to find these old clunky automobile companies are the ones doing well, and this glorified battery stock is just not, right? Look at Newmont Mining breaking out of a 25-year base. Again, things we haven't seen in a while. Growth, continuing to underperform value. Things we weren't seeing before. Ford breaking out relative to Tesla. Things we weren't seeing before. Newmont Mining breaking out to all-time highs. Again, things we haven't seen in a long time. Look at gold relative to Apple, getting back above those former lows. I put this one out on StockTwits and Twitter, got a ton of trolls. And when the trolls come out of their caves or their mommy's basement or wherever they hang out, I'm probably onto something. I've been at this game for a long time. I've been sharing my charts and analysis since social media was invented. So I have more experience, or just as much experience, trying to recognize market sentiment than anybody else. And I'm confident that over the years I've gotten better at really analyzing it. And I gotta tell you, one of the common themes throughout my career have been when the trolls really get loud and really get upset. Again, I'm probably onto something. And boy, the trolls really don't like this one. The gold bugs love it. But the Apple people that they're like, well, JC, I've made all this money in Apple, and I bet you did. And it's like, what does the money you made in Apple have anything to do with the fact that Apple's a good short now? What does your cost basis have anything to do with the fact that our Apple shorts are working? Like that might bother you, but that's not my problem. Like I'm not your therapist, right? Like go pay for a therapist instead of bottom fishing stocks and downtrends. So Apple's been a short since it was at 138 when we retested those February highs, right? Shorted with a target down near 80. It's down. Apple's now down 5 consecutive weeks, and I think that it really gets crushed. One of the things I love about the Apple short is that Kathy Wood over at the ARK Funds uses Apple as a cash equivalent. Like, man, that's like the scariest thing I've ever heard. If it's music to my ears because we like shorting Apple. But if I were long Apple, that would scare the hell out of me. If I were long the ARK funds, that would also scare the hell out of me. So needless to say, it reminds me a lot of 2012. In the old days, I actually used to have we used to have comments on our blogs, and man, you should have seen the comments because my title of my blog post was "Is Apple stock about to crash?" So back then, these people were, this is before laser eyes. Like these were the laser eyes of 10 years ago, was the Apple crazies. So when I was like, Apple's going to get crushed, oh my God, the trolls were out of control. Obviously, we were very right, and Apple got crushed. And it's funny because if you go back and read the comments, it was like, oh, they're coming out with the iPhone 4 or something like that. And I remember joking, be like, oh, I'm going to wait for the iPhone, the Ocho. And then now I think we're like on iPhone 10 or 11 or 12. I don't even know. So it's just funny looking back on it. Needless to say, the reason I bring up the 2012 short of Apple is because it was really doing the same thing. Apple stock was making new highs, and then relative to the S&P 500 was putting in lower highs. Momentum was also putting in lower highs. You had all sorts of divergences, and we have that here, and it's working. And it's the right space to be shorting, right? Growth stocks have been great shorts, not the value areas. So Apple just fits right in there. I really like it a lot. By the way, if you're interested in these slides, please email info@allstarcharts.com. Make sure to use the password Divergences Galore. So info@allstarcharts.com. And again, make sure to use the password because I give a bunch of presentations. I'm giving a pot stock presentation tomorrow, for example. So if you don't use the password, you're going to get the wrong deck. So if you want this deck, Divergences Galore is the password. All right. So yesterday was Tuesday. On Tuesdays, we come out with our currency report and, major tops in dollar CAD. Looks a lot like the dollar index if you really clean it up. And we're making new lows. So if we're below 122.5, I think you're short dollar CAD. I think you're long CAD, 122.5. Be careful for a whipsaw because this thing's come down a lot since last year. So really look out for a whipsaw. We only want to be short dollar CAD if we're below 122.5 with the target down near 102. So I like buying CAD on this breakout if we're holding above that. An interesting tell will be in pound sterling. The title of this week's currency report was, is the US dollar about to get pounded? And I thought that was clever. Shout out Ian for the title. And what I see here in British pounds is just support in the 90s, support in the early 2000s, support 10 years ago or so, and then we broke. And then we kicked back and retested that level a few years ago, sold off again, double bottom, and now we're back to the scene of the crime. 142 is my level here. If we're above 142, I like buying British pound sterling against the dollar. Again, only if we're above 142. If we're below it, leave it alone with a target up near 171. A lot of upside there. And then one thing that's got to stand out is crude oil. This looks like a real breakout. We're holding above that 66 level. Those were the highs throughout 2019. If we're above 66, you got to be long oil with a target of 76. Take a look at those oil and gas stocks. Look in particular at XLE, which is the sector index. Right now, we're right there, right at 55 and change as I'm recording this. So I would highly encourage everyone take a look at that XLE. If we're above 55, it puts the XLE, which is the energy stocks ETF, above those key 2016 lows. So oil above 66, XLE above 55, and I think it's all systems go on energy commodities and energy stocks, in my opinion. One thing that, one of many divergences that we're seeing that continues to suggest heavy cash positions, larger short positions in stocks, as well as looking more defensively at things like gold and bonds and cash and those sorts of defensive areas that I continue to like, and they keep working. Bonds aren't so much working, but they're not working, right? Bond prices they're not losing us money. They're making us a little, probably not as much money as we would like, but they're not losing us money at least. So we still like those bond ETFs, long bond futures, long the whole inflationary, the fact that Barron's keeps coming up with these inflation covers. You got all the journalists around the country telling all their poor readers that inflation's here, all that stuff. I think you take the other side of that. Remember, a year ago, they were telling you that deflation was here when it was the exact opposite. And now they're all telling you that inflation is here. So, hey, I'm willing to bet that the opposite is probably true also. What's interesting is that lumber futures are making lower highs. I looked up the Google Trends search, as I detailed up here above. The Google Trends last month hit 100, which according to Google, a value of 100 is the peak in popularity for the term lumber. So a lot of people are interested in it, obviously near the highs, nothing like prices to change sentiment, right? So lower highs in lumber futures, suggesting, in my opinion, stocks are going to get hit too. Further evidence that we should be shorting stocks, not buying them. For the most part, there are exceptions, and we'll talk about some of those. But for the most part, we like shorting stocks or selling them in general. And one thing I think is really going to confirm that is if this tight little flag in US 30-year yields breaks down and we get back below those former lows in 30s, things can get real nasty, real nasty. And the US 10s 1.4, which we're well above that, but I think 30s will be the tell first, and then look for 10s to follow along and break 140. I think that's probably the higher probability outcome. And then look at US 5-year yields holding above those former holding below those former lows, just below 1. If that's the case, I think you got to buy bonds. I think one of the things that will prove me wrong, and I got a whole bunch of them, copper gold ratio breaks out to new highs, regional banks breaks out relative to REITs, and also 5-year yields breaks out above 1%. I think if all those things happen, then we probably shouldn't be shorting bonds, and then that trade is just wrong. But with the copper gold ratio rolling over, regional banks severely underperforming REITs, and US 5-year yields stuck below 1%, I think buying bonds makes sense. And if 30 years breaks those former 2015, 2016 lows, I think there's a lot of downside here, and I think that's good for bonds. It's probably bad for stocks, so our shorts are probably doing well in that environment. Look at US 2-year yields making new lows, and by the way, US 1-year yields lowest levels ever. So if you're bullish stocks, then the bet that you're making is that this doesn't matter, right? This is just like this one little thing, and don't worry about it, everything's going to be fine. So if you're buying stocks, in my opinion, it's because you don't think that this matters. I don't know whether it matters or not, and we were shorting stocks before US 1-year yields broke down, but something to, this certainly suggests we should keep an eye on it. And I think it says sell stocks. So continuation patterns, we're here. I'm doing a video here for StockCharts TV. Shout out StockCharts. And, for me, I think you guys have noticed, I'm a very John Murphy guy. I'm a John Murphy disciple through and through. You look at my intermarket analysis, you look at the simplicity of my charts, you look at the sector rotation that we do. You find a lot of John Murphy in my work. And sometimes I get people that are like, oh my God, JC, John Murphy's copying you. And it's like, no, I'm copying him. And, I don't really read his notes like I used to in the early days, but I used to find, and I'm sure it's still the case today, we'd put out a note and then 2 days later, he basically puts out the same note. Or he puts out a note and 2 days later, we put out a similar note. And I'm sure that still happens. I haven't, in hindsight, I should probably read Murphy's notes a lot more. And I'll probably find that happens all the time. Because, I as a Murphy disciple, we're probably looking at similar things. And I tend to catch that quite often. So shout out John Murphy if you see him. Tell him JC says what's up. So needless to say, not just John Murphy, but Edwards and McGee. I mean, any technical analysis book is going to tell you that these consolidations should resolve in the direction of the underlying trend. And obviously, materials and financials, the trend has been up. So these consolidations should resolve higher. However, looking at all the intermarket relationships and trends out there, I would not be surprised if these consolidations did not resolve higher and instead resolved lower. And sometimes when that happens, you get people on Twitter, it's like, oh my God, technical analysis doesn't work. And it's like, no, no, no. It's not that technical analysis doesn't work. It's that maybe your technical analysis didn't work, right? Just because the book says that this consolidation should resolve higher doesn't mean the market gives a damn what's in that book you read, right? In fact, I'll take it one step further in that when these consolidations that should resolve in the direction of the underlying trend do not, that is the signal. So if you see materials and financials breaking down here, it's a big heads up that shorting stocks is the right move. And man, if financials are ever going to sell off, this would be a perfectly logical place for it to happen. Look at those early 2018 highs down to last year's lows, and exactly 161.8% of that entire move takes us exactly where stocks, where the financials peaked a few weeks ago. So if this consolidation is going to resolve lower, this would be a very logical place for it to do so. So we're keeping a close eye on that. All right, so this weekend, we rolled out one of the scans that we've had internally for a long time that we've actually never published publicly, like maybe a stock or two that comes up on unusual options activity for sure we'll publish, but for the most part, we just keep this internally. So what we're looking for is unusual flow, and we put it through, rigorous screening, because it's not just random unusual activity, whether it's on the bid or whether it's on the ask, all of that stuff matters. So we take into account, pretty complicated. I mean, for me, it's just annoying to do. So we have a big team that helps me do that. So we do this for you. So you don't necessarily have to worry about any of that. We're doing the hard work for you, and we are identifying whether these are bullish or bearish, and whether these monster financial institutions are making very aggressive bets on either the long side or the short side. So big, heavy options activity on the bullish side coming in for Oxy. It's the right space, this 24 level. I mean, it just took off over the last couple of days. So if you got it this weekend, good for you. But literally over the last 2 days, this thing has ripped. The idea was to be long if we're above 25. It has been. I think this goes to 48. I think there's a lot of upside. Check the warrants on this one because it does trade warrants as well. Look at BRFS. This is another one where it had a bunch of bullish activity as well. Also has taken off the last couple of days. So I know I'm a little late on these. I didn't do that on purpose. I promise. We put it out this weekend. There's bullish options activity for a reason, right? Somebody knew something. So big moves. I think 6.5 is next. We're about halfway there already. And then we got a ton of bearish activity in the ARK Innovation ETF, ARKK. Big money coming in, shorting this thing. I love how she uses Apple as a cash equivalent. That makes me even more bearish. I love how she became the poster child for the growth bubble. I love it when you could point to someone and be like, that's the leader of the group. Again, it all fits in. So I like shorting the hell out of it. If we're below 111 on ARKK, 111 is my level. If we're below 111, I like it short with a target down near 80. I think that this thing gets crushed. Something else that's interesting, I talk to a lot of smart folks, people way smarter than me, people with way more AUM than me, people who talk to way bigger portfolio managers than I do. And what I'm hearing is a lot of chatter, maybe not a lot of chatter, but some chatter of ARK funds blowing up, which I like to hear, especially if we're short. So something to keep an eye on. Another one dropped this morning. This is the Under the Hood report. Our Under the Hood report scans for stocks showing an unusual increase in investor interest, whether it's a spike in social media mentions or volume or insider transaction. But for some reason, investors around the world are paying more attention to this list of stocks than they were before. And like the unusual options activity, or the follow the flow report, as we call it, in this case, it is also both long and short. So here we have a few longs. Here's Tellurian, am I saying that right? TELL. And this thing has absolutely exploded. The idea was to buy it above 4 with a target above 8, and we're already at 5.25. So it's already making moves, breaking out on a relative basis. So keep an eye out there. Transdigm. How come I can't pronounce any of the damn companies today? Transdigm TDG. I like it if we're above 665. That's the level. 665 puts us above those last year's highs. So when we're breaking out on a relative basis, that's great, but we want to be above those former highs. If we're not above those former highs, we can't be long. But if we are, I like it long with a target of 950. Upstart Holdings, UPST. So UPST coming from the under the hood report, trying to break out on a relative basis. For me, 167 is that level. We're still below that. So keep an eye out there. 167, we only want to be long if we're above 167 with a target up near 220. To be clear, we currently are not above that level, so we do not want to be long, but a breakout will trigger that for sure. And if you, finally, if you are interested, again, in these slides, make sure to email info@allstarcharts.com. Make sure you use the password Divergences Galore. Info@allstarcharts.com. Password Divergences Galore. So I'll leave this up while I look up some questions that came in. One of the first questions is, JC, if rates drop like you're saying that they could, isn't that bullish for growth stocks? So if rates go down, is it bullish for growth stocks? I would say no. And mostly because I don't think it would be bullish for stocks in general. And growth stocks, by definition, are stocks. So I think if rates are coming off and bonds are getting a serious bid, I think it's mostly defensive rotation continuing. Notice how interest rates stopped going up in March, have really been going sideways for the last few months. Notice how bonds themselves has stopped going down in March and have been going sideways for a few months. So I would argue if those interest rates, particularly US 10-year yield, resolve this consolidation since March lower, then stocks are likely to follow them lower as well, and reiterates that buying bonds is a good move. Buying bonds hasn't been a bad idea because it's kept us away from stocks, which have mostly been going lower, but bonds themselves haven't been going up. My suspicion with the copper gold ratio rolling over as hard as it has is that bonds are about to rip. So we will keep an eye on that. The trade continues to be IEF. If IEF, which is the 7 to 10 year bond ETF, is above 114, we want to be long bonds, whether it's through an ETF, whether it's through 30-year futures, TLT. There's a million different ways to take advantage and get bond exposure. But again, I think the cleanest chart is the IEF, and we only want to be long bonds if IEF is above 114, and currently it is. And that has really been the ceiling. 114.5 or so has been the ceiling for the last few months. A breakout there, I think, would be incredibly encouraging for bond investors. JC, but Kathy Wood is the next Warren Buffett. Why would you be short her funds? Well, it's funny that it's a good question because I've heard the next Warren Buffett many times throughout my career, and they all panned out to not be. More recently, there was a gentleman named Shamath. I don't know him personally. They said he was the next Warren Buffett. And then I look at all those SPACs he launched, and like they're all like cut in half. They've gotten destroyed. So I guess he's not the next Warren Buffett. So there was a guy named Harold Miner who he used to play for the Miami Heat in the 90s, and they used to call him Baby Jordan. The next question is, who is Harold Miner? Exactly. So, you know, when they say the next Jordan, when they say the next Warren Buffett, be cautious. With all due respect to Kathy Wood, I don't know her. She could be great. It's not my problem. She could be a terrible person. She could be a great person. I still want to short her funds, particularly if ARKK is below 111. If we're below 111, we want to be aggressively shorting Apple, her cash equivalent. Love that. And looking to put on more gold positions, more bond positions. And that's it, guys. My time is up. Again, I'm JC Parets. Let me just throw on the deck. If you're interested in these slides, email info@allstarcharts.com. Use the password Divergences Galore. This is JC Parets from All Star Charts, signing off.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.